Hi, my name is Paul, and in this video, I'm going to be covering MTY Food Group's 2023 second quarter financial results and conference call. Then, I'll briefly go over what I think about the current stock price and whether or not I'm planning on investing more money after this quarter's earnings. First, to briefly summarize MTY Food Group's business, MTY is a Canadian company that trades on the Toronto Stock Exchange under the ticker symbol MTY. The company owns over 90 different fast food and casual dining restaurant brands throughout the US, Canada, and abroad, and their main business model involves franchising out these brands. However, the company also operates a small portion of particularly profitable locations, and they also offer retail food products centered around their more popular restaurant banners in select grocery and convenience stores. Now, when going through an earnings report, I almost always prefer to read the management discussion and analysis version of the report, since it gives additional commentary by the management explaining what caused the results to turn out the way that they did. But on MTY's investor relations page, they only link the standard report. So if you're like me and you want to read the MD&A report, you'll have to go to cedar.com to download the official version of that document. Opening up the report, let's start with the revenues. And here we can pretty clearly see that the Canadian revenues increased moderately over Q3 of last year, and that the US revenues are still insanely skewed by the recent large acquisitions of Barbecue Holdings Group and Wetzel's Pretzels, which I'll get into in just a second. Honing in on the Canadian revenues, we can see that there was a solid 10% year-over-year increase in the franchising portion of operations in Q3, and most of this was organic growth. Unfortunately, there was also a slight decrease in the food processing, distribution, and retail segment, and in the report, this was attributed to slowing sales in specifically the food processing and distribution subsegments. But on the conference call, it sounded like the retail segment was also slowing down, and this was explained as being a byproduct of the challenging situation facing retailers. More precisely, this situation involves the Competition Bureau of the Canadian government targeting the grocery chains for profiting too much off of consumers due to an alleged lack of strong competition in the sector. In my opinion, this isn't exactly a valid reason for going after big grocery, especially when you take a moment to consider that grocers operate with some of the slimmest profit margins that you'll find among blue chip companies. But regardless of how I feel about the government's desire to crack down on the 2 to 4.5% profit margins, this is probably just going to be a short-term obstacle to overcome for MTY Food Group. And the CEO did note that retail might be challenging right now, but it is still a priority opportunity with a lot of future growth potential. And I tend to agree with them on that. In the US, the numbers are still heavily distorted by the acquisitions, so I'm going to jump right into the franchising revenue breakdown. And while this isn't quite as messy as the corporate revenues, we still need to do a fair amount to isolate for the organic franchising growth. So first off, I want to remove any of the non-recurring gains or losses, which in this case include the increases due to acquisitions and foreign exchange related gains, and part of the decrease due to the line item initial franchising fees, renewal fees, and transfer fees. And this is just because the initial fees are usually higher one-time payments that aren't recurring, unlike the renewal fees. So, doing this would mean that the organic revenue growth for the US and international portion of the business was relatively flat year over year. I'm not going to sugarcoat anything here. This was a sour note for me this quarter. Thankfully, things were far from glum for the rest of the report. See, this quarter, MTY opened almost double the number of restaurants that they did during the same quarter last year, and they closed less locations comparatively as well. Now, there was still a net closure of 4 total locations in the quarter, but this is a significant improvement, and according to the management, this was the best quarterly net result for the company in 9 years when factoring out locations gained via acquisition. And this shows that the management's recent initiatives appear to be on the right track. But the good news doesn't end there. On the conference call, we also got some insight into who is opening up the new franchise locations. And as it turns out, nearly 50% of new franchises are being opened up by existing franchisees. which indicates that many of MTY's franchisees are realizing success in operating their restaurants. In addition to that, this highlights that there are restaurant banners that are performing very well, such that there is continued demand from existing franchisees to open even more locations, which likely points towards more franchise sales in the future for MTY, since the franchisees will be making more profit, which can then be funneled into even more locations that will make even more profit, incentivizing existing franchisees to become return customers and eventually serial location openers. So it's nice to know that the company's franchising network is creating a sort of flywheel effect that is symbiotically making both the company and its franchisees wealthy. Moving on, this quarter I'm just going to very briefly touch on the operating expenses since the Canadian section was pretty well flat relative to the revenue growth. Meanwhile, the US side of things is of course still a complete mess due to the acquisition of a large number of corporate stores that do require capital maintenance on a regular basis. Plus, at the end of the day, what I really want to know as a shareholder is what are the profits and where are they going to be in the future? One of the best metrics for calculating profit is free cash flow. And this quarter, the free cash flow per share was up 77% over the same quarter as last year, coming in at $1.84 per share versus $1.04 per share. Historically speaking, second quarters have always been among the worst free cash flow quarters for the company. So it being among the best free cash flow quarters ever this time around is incredibly promising, especially since third quarters have historically been among the strongest for the company. So it's going to be incredibly interesting to see how the free cash flows are impacted for this upcoming third quarter. Now, to temper some of your expectations a bit, this doesn't inherently mean that the next quarter will result in the best blowout earnings of the company's history. See, these acquisitions are new, and it could be the case that their customer base is at its largest in Q2, and that it wanes during Q3. Unfortunately, we just don't have the experience to properly know what to expect from these newly acquired businesses in the third quarter. And as investors, it's important not to get overly hyped up on things that may not come to fruition. That said, from the conference call, we do know that in this past quarter, there was temporarily higher capex of $3.5 million coming from the flagship restaurant build of a Baton Rouge location that completed within the quarter. And in addition to this, we got an update on the obligatory builds pertaining to the Wetzel's Pretzels and Barbecue Holdings acquisitions, and it sounded like the builds on these restaurants are expected to be completed by the end of Q3. So in future quarters, there is expected to be less of these capital expenditures weighing down the free cash flows, which potentially points towards some really promising upcoming quarters and long-term profits. Noting that, we still have to be aware that there are other expenses that aren't factored into free cash flow, and the most important of those in MTY's case is interest expense. Now, because of the huge debt load taken on from the recent acquisitions and the recent increase in interest rates, MTY does have a lot of interest to pay down on a quarterly basis. But because they've been doing a good job of paying down debt, the interest owed on that debt is at least a little bit lower than in last quarter. And as you can see here, the company is expected to be required to pay down about $27.5 million every 6 months or so. Though, again, this is based on the current amount of total debt owed by the company, and the management did say on the conference call that their central focus is on paying down debt. So, in reality, unless interest rates continue to rise dramatically, or MTY finds a new big acquisition that requires taking on even more debt, the full value of these interest expenses shown here are not likely to be realized. Now, in line with the sentiment expressed by the management, the company paid $16 million in interest expense during the quarter, and the company also paid down about $27 million of long-term debt, which, to be perfectly transparent, is just a drop in the bucket, but each payment has a compounding effect in that it lowers the total interest expenses owed, and this increases the amount of money that can be used to pay down debt in each preceding quarter. So the reality of the situation is that the debts should be paid down to historically comparable levels within a few short years, assuming of course that there aren't any additional major acquisitions or pitfalls in the near future. That said, this is a truly huge amount of debt, and it should not be taken too lightly. Also in line with the management's goal of reducing debt, we haven't seen any additional capital being allocated towards repurchasing shares, which we already knew from the filing of the normal course issuer bid a few days before the report came out. While we're on this page, we can also see that the debt owed on the revolving credit facility has now fallen below 590 million US dollars, and that the company has over 62 million Canadian dollars in cash, which should be instrumental in helping to pay down another chunk of debt for next quarter. Now, before moving on to the outlook for the company, I do want to touch on one big change to the accounting standards that was recently put into place, creating a $6.7 million gain for MTY within the quarter. This involved a change to IFRS 16, which requires that a seller lessee must subsequently measure lease liabilities resulting from leasebacks in a way that does not recognize any amount of the gain or loss that relates to the right of use that it retains. If you happen to speak common English, you're probably more than a little bit lost right now, and honestly, I was too when I first read it. But I took the time to go through the examples listed on the IFRS website and was able to parse through what's going on here so you don't have to. And I'll attempt to simplify everything as much as possible. So, what this change means is that if a company sells a property but then enters into a lease agreement that allows the seller the right to use the sold property, then the selling company must measure the value of its lease as a liability, which will be used to offset any gain or loss made on the sale of the property. Hopefully that helped to simplify things a bit, because now I'm going to break down how I believe this is benefiting MTY, which, as a franchisor, is in a unique position to capitalize on this change. See, when MTY builds a restaurant location, it can then sell the property to the franchisee, but MTY is then able to lease the property for its brand's purposes. These leasing fees will then flow through back to the franchisees, who aren't technically paying a leasing fee, but instead they're paying a franchising fee, which essentially creates a loophole wherein MTY can avoid paying a chunk of taxes on the gains from the sale of new locations. If that was still a bit too confusing to follow, the short and sweet of it is that because of these new accounting standards, MTY can classify part of its gains on new franchises as leaseback liabilities, which allows them to pay less in taxes and earn more in profit. And on the conference call, it was stated that this adjustment will result in recurring variance until a full year of the new changes has gone by. So, unless additional changes are made to the reporting standards, there is very likely to be an additional, relatively stable amount of money rolling in each quarter. But this will not result in organic growth. Anyway, with that out of the way, let's get into the future outlook. It's here that we learned that despite the continued labor challenges, business is remaining strong. And on the conference call, it was noted that labor has stabilized and that MTY isn't having as many challenges with acquiring staff as they were a year ago, though things are still a ways off from where they were during pre-pandemic times. Next, we learned that despite the recent recessionary fears, MTY has yet to experience any of the slowdowns that had previously been predicted, which is obviously a good thing for a company that would be negatively impacted by a scenario wherein discretionary cash is harder to come by. Next, we received more reassurance that the debt is the company's top priority, though if there is a well-priced acquisition opportunity, the company will likely go for it, which, in my opinion, is the right stance to take. Currently, the debt levels are quite high, but I don't think they're paralyzing, so I think it would be a mistake to pass over a heavily discounted free cash flow accretive opportunity, even if it tacked on a bit more debt. The last little bit that I want to go over is the focus on adding new locations of existing franchises. See, on the conference call, we were provided with some color on the topic, and the management mentioned that a large number of the recently opened international locations were Cold Stone creameries, which appears to have growing international franchise demand. In the same vein, we also learned that after a slow first quarter, Papa Murphy's has experienced a bit of a resurgence and it performed very well in Q2. Finally, we got a few words out of the CEO in the question and answer segment when he was asked about the likelihood of selling off some of the underperforming brands. And Lefebvre answered in a very Buffett-esque way by pointing out that he doesn't like the idea of abandoning brands and franchisees that are part of the MTY family, and that he would only consider selling a banner if the deal was beneficial to everyone involved. Personally, if I were a franchisee, this is exactly the sort of sentiment that I would be looking for when considering entering into a franchising agreement. Because if my hypothetical franchise were to potentially enter into a situation where it was struggling, I would want the backing of the brand owner behind me, working on solutions to turn things around, rather than taking the first chance to get out of Dodge, selling everything for scrap to the highest bidder, and leaving me in the lurch, unsure of whatever future may belie me. So, all in all, I was pretty happy with this quarter. But that still leaves the question, is the stock trading at a reasonable valuation? Well, we know that next quarter is likely to have a boon in free cash flow due to the reduction of one-time capital expenditures from building costs, and that these costs will likely decrease again in Q4 for the same reason. Plus, we know that historically, Q2 is usually the worst month in terms of free cash flows per share, and Q3 is typically among the best. Now, if I had to bet, I'd bet that these two factors will lead to next quarter having blowout earnings results and massive share price appreciation. But thankfully, I don't have to gamble. I'm an investor and I require a certain level of security before I'll put any of my capital at hazard. See, it could very well be the case that my hypothesis, based on past performance, doesn't pan out in future quarters due to changes in the business's structure. Or it could also be the case that there are challenges within the obligatory builds that lead to higher or sustained capital expenditures for several additional quarters. So, to avoid losing risked money on bets that might not pay out, I like to be conservative and invest with a margin of safety. That way, even if things don't go as I would hope, I'll still make money. In MTY's case, that means I'm going to assume that the free cash flow per share in Q2 is the highest that the company will achieve for any quarter within the preceding year. Then, I need to consider what I can alternatively receive if I were to instead invest in a risk-free asset. In this case, I'll be using the 1-year Canadian Treasury bill, which is currently offering about a 5.1% yield. So, I'm essentially getting a price to earnings yield on the Canadian Treasury bills of 19.6. Meanwhile, if we calculate MTY's conservatively adjusted free cash flow yield, we're probably getting the company at a price to free cash flow of somewhere around 10, which is quite cheap. However, MTY does carry a lot of debt on the balance sheet, and they have to pay a fair amount of interest on that debt, which is not accounted for in the free cash flow figures. Noting that, MTY has shown themselves capable of paying down large sums of debt, and, as I explained earlier, as debt is paid down over time, the interest expenses are able to become compoundingly smaller. So, I do like to discount debt on a case-by-case basis depending on the company and its history. In MTY's case specifically, the company is trading slightly below what I'd be willing to pay for it, assuming a moderately poor short-term future scenario. But over the long run, I do see the company being a strong compounder, and because of this, I think that it does deserve to trade at a slight premium as well. So even though the share prices have risen quite a bit from my early purchases in the high 40s and even the high 50s, I'm still going to be a happy buyer of shares in the mid to high 60s. And given the competency of the management, the quality of the business, and its opportunities for future expansion, I will probably continue to be a happy buyer of shares even if they reach prices into the high 70s. Now, for the purpose of full disclosure, I am a shareholder of MTY Food Group in multiple accounts. Recently, I sold my entire stake in Knight Therapeutics within my TFSA at TD, and I invested all of the proceeds into shares of MTY Food Group. MTY is also my third largest holding within my Canadian cash account, also at TD. And MTY makes up my second largest position within my Wealthsimple Canadian stock portfolio series, where I invest $100 of real money every month into Canadian stocks and track the progress here on the channel. So, my interpretations of events and facts may be biased, and while I do attempt to combat these biases at every turn, it is possible that some may find their way into my coverage. Also, I am not a financial advisor, and my opinions should not be confused with facts. It is very possible that my assumptions are incorrect, so it is of utmost importance that you put in the time and effort to do your own research and come to your own conclusions using primary sources before making any investment decisions. Again, I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions. This video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes investing and sharing what I've learned with others. In doing so, I hope that I was able to provide you with something of value, and if I did, then please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.